Asymmetric upside strategies. You cannot build a sustainable trading career or even an investment career on naked puts alone. The math doesn't work when sequence risk materializes. The answer, occasionally buy options to create asymmetric upside that isn't dependent on selling premium. Use debit call spreads, long calls financed by short calls. The hidden danger of selling naked puts. Selling puts can generate consistent income until the day it stops working. Understanding assignment risk and sequence risk is critical to avoiding catastrophic account blowups. I know all these people get on YouTube and they tell you that selling naked puts is really easy money, but there's a lot of downfalls when you sell naked puts. Specifically, when the market is going up, your main way of profiting is by collecting option premium from selling those puts. The issue is, as the market goes up, you're going to be tempted to increase your size and sell even more naked puts just to keep up with the market. Why traders love selling puts. Selling naked puts feels like collecting rent on stocks you'd be happy to own. You know all the people out there who are telling you that it's easy money and that you're creating retirement income? The premium arrives instantly. Theta decay works in your favor. And week after week, the strategy, quote unquote, prints money. High win rates create false confidence. 80 or 90% of trades expire worthless, but that consistent income masks a dangerous vulnerability that most traders don't discover until it's too late. Similar to what happened in December 2025 with David Chow from Inside Options. He was known as Captain Condor, and every single time he would lose a trade, he would double his betting size. He would do iron condors on SPX, and after him and his group lost about 5 or 6 times, they were completely wiped out. I think they lost about $50 million in total. So when you're selling puts, everything is great, but there's always a moment that everything changes. Before assignment, selling a $50 put requires $1,000 in margin. This is if you're using Regulation T. Your capital works efficiently. After assignment, you now own 100 shares of $5,000. Your buying power requirement just increased 2.5 times overnight because the buying power requirement on those shares is going to be 50% of the $5,000. Now, going back to what I was saying before, as the market's going up, people start feeling elated. We're in a bull market, but volatility is decreasing. That means that for every option that you're selling, you're going to be collecting less premium. Therefore, a lot of traders are going to be increasing their size. Then after a 5% pullback, VIX spikes up from 15 to 25. And 25 in the VIX is not even that high. I believe in March 2020, the VIX hit a high of about 84. In this situation, you're going to have correlation risk. If you're assigned shares, then instead of 20%, you're going to require 50% maintenance margin. And if you had 10 puts assigned, you need $25,000 in maintenance margin, not the $10,000 when you were trading options. I made a video about this recently about Abundantly Erica, where she was using a lot of margin. I believe she showed that she had a negative cash balance of $52,000 or $54,000. And then in the pullback that happened in the middle of November 2025, after the market pulled back by only about 5 or 6%, it's my opinion that she was down around 30% in her account, and I also believe that she got a margin call. The 2.5 times buying power trap. Naked put uses 20% of notional value as margin. Notional value simply means the total value of those shares, as if you were using a cash account. So if you sold a naked put at $50 and then you were assigned 100 shares, the notional value on that would be $5,000. Share assignment requires 100% cash or 50% margin. That's a 2.5 times to 5 times increase in capital requirements when you can least afford it. During a market crash, when all of your positions move against you simultaneously. Sequence risk. When one falls, they all fall. The cruelest lesson in options trading. Assignments rarely happen in isolation. When volatility spikes and the market drops 10%, suddenly 5, 10, or 20 of your put positions are in the money simultaneously. One put goes in the money. Assignment seems manageable. Then there's a cascade effect. Correlated positions collapse together. Suddenly you have a $100,000 margin call or emergency liquidation at the worst prices. And this is one of the hardest parts to fathom. If you sell a lot of naked puts and you're forced into a margin call, you can be forced to liquidate the position at the absolute worst time, only to then see about 1 or 2 weeks later that you were right all along. But because you no longer are holding on to that position, your loss is permanent, but the stock price decrease was temporary. This is sequence risk, the devastating reality that your diversified portfolio of naked puts is actually a concentrated bet that markets stay calm. When correlation goes to 1, your entire strategy implodes at once. Real account blow-up scenarios. I mean, hey, go check out that video that I put out on Abundantly Erica, where in my opinion, I believe that she was forced into a margin call after the market fell only 5%. The overconfident trader sells 30 puts across different tech stocks. Market drops 15%. All 30 get assigned. They then need $150,000 buying power, but they only have $40,000. They're forced to liquidate at massive losses. Because remember, as your net liquidation value decreases, as stock prices come down and VIX increases, you're going to need more and more capital injections and excess liquidity to compensate for the decrease in your net liquidation value. The yield chaser aggressively sells puts to generate income, uses 80% of available margin, small correction triggers assignments, no capital buffer, margin call within 48 hours. And actually, I think if you're using portfolio margin, you can get a maintenance margin request that I think is due that same day. And some brokers, I think Tasty Trade and Interactive Brokers and maybe Webull and Robinhood, I think that they will proactively close out positions in order to mitigate risk to the brokerage. Now, real quick about the 80% of available margin. If you're only going to trade vertical credit spreads, which neutralizes the volatility expansion component, then I guess it's okay to use 80% of your available margin. Personally, I wouldn't do that, but because vertical credit spreads are defined risk and they neutralize the volatility expansion risk, I guess it's okay. But if you're going to trade naked, in my opinion, you should never use 80% of your available margin. The "it won't happen to me" trader ignores tail risk for months. Black swan event hits, 15 positions assigned overnight, account value drops 60% while liabilities triple. Just like Chris Sane says, yo, that's a life-changing gain. It'll change your life. Well, these are life-changing losses, and you definitely don't want to experience one of those. The solution: asymmetric upside strategies. You cannot build a sustainable trading career or even an investment career on naked puts alone. The math doesn't work when sequence risk materializes. The answer: occasionally buy options to create asymmetric upside that isn't dependent on selling premium. Use debit call spreads, long calls financed by short calls. Technically, that's actually incorrect. If you wanted to go long a debit call spread, you would buy a call and then you would sell a call that is at a higher strike, but you wouldn't necessarily finance it by selling calls. So a debit call spread would be something like if a stock is trading at $70 and then you would buy the $90 and then you would sell the $100 to generate positive returns during market rallies without increasing your assignment risk. Remember, the market has a tendency to go up, but you don't want to only buy calls or sell puts. The best strategy combines both with some hedging. This is a strategy for all markets, a lifelong strategy. Oh man, those typos. This is the A. I used to be an investment banker, and I remember when I was working on a pitch book at about 11 p.m. And in the pitch book, the fonts on one of the pages were slightly different. One of them used Arial and the other one used Times New Roman. And Brian Cotter, who I think now works with PwC, he's under John Woodby, who joined us when he was working at Goldman Sachs as a banker. But Brian Cotter looked at the document that I gave him and wrote WTF ? And then circled it, and then he threw it back at me. So yeah, those typos, they're a big deal. Strategic framework: finance calls with puts. Sell naked puts, generate consistent premium income on quality stocks at a price you want to take ownership, but you're selling a lot less puts because it's not your primary moneymaker. 2. Use premium to buy call spreads. Take the put premium and purchase debit call spreads. These give you leveraged upside exposure with defined risk. While it's true that they give you leveraged upside exposure, It's not necessarily defined risk because you're selling naked put options. I guess it's technically defined because the most that you can lose is if the stock goes to zero, but it's not defined risk if you're selling naked puts. But the better strategy than selling naked puts is to buy debit call spreads and then finance it by selling naked put options. And the reason is that there is an arbitrage opportunity. If you buy an out of the money debit call spread, let's say it's $10 wide, you're probably paying around $2 or $3 for that. You can then sell put options at a strike price where you would love to take ownership of that stock. Therefore, it's kind of like a win-win. Either the stock goes up and then you profit from the call debit spread. The stock doesn't really move much, in which case all of the legs, both the call debit spread and the naked short put, expire worthless. Or if you're assigned, you're not going to be assigned as many put options and you're going to be assigned shares at a much lower price. 3, capture asymmetric returns. When the underlying rallies, call spreads can return 3 times their cost, while puts expire worthless. Both sides win. 4, reduce sequence risk. Directional call profits offset need to sell too many puts. This is extremely key, especially during bull markets when people are euphoric but volatility is really low. You're not really picking up that much premium and you're not collecting that much money for selling naked puts. As a result, by you participating in the upside potential, you are mitigating the need to sell too many naked puts because you're profiting from the call debit spread. Therefore, if the market pulls back, there's a much smaller chance that you'll be forced into a margin call. This balanced approach transforms you from a one-dimensional premium seller into a strategic trader who profits in multiple market environments, which is completely true. Hey, if the market flips and we enter a bear market, instead of buying call debit spreads, you can buy put debit spreads. Portfolio protection metrics. Naked puts only, max drawdown, significantly higher, and the recovery time is going to be significantly higher. Puts plus the call spreads, a much less drawdown, and the recovery time is going to be a lot less. Remember, if you lose 10% of your account, you only need to make about 11% to get back to even. But if you lose 50%, you need to make 100% in order to get back to even. Data shows that adding strategic long options reduces maximum drawdown by over 50% and cuts recovery time by 2/3. The cost is minimal, but the protection is invaluable. Now, to be completely transparent, here it says data shows. Maybe the data shows in this specific chart, but I'm not aware of any explicit research studies that validate the exact magnitude that this graph shows. But from personal experience, from someone who's traded for over 20 years, I can tell you that adding long call debit spreads and financing it with naked puts and therefore decreasing the amount of naked puts that you're trading is going to substantially reduce your portfolio volatility. Key takeaways. Assignment risk is real. Buying power requirements increase around 2.5 times when puts get assigned. During the exact moment you can least afford it. Sequence risk multiplies danger. Assignments cluster during volatility spikes. One position going in the money often means 10 positions going in the money simultaneously. Diversify your income sources. Don't rely exclusively on selling premium. Use debit call spreads to create asymmetric upside that protects your account during drawdowns. And finally, finance upside with premium. Allocate the put selling premium to strategic long options. This, along with many other strategies that we use in our live option trade signals and alerts, can transform you from a premium collector into a complete trader. And that's it for this presentation. If you have any questions, leave a comment below. Please like this video and also let me know if you like these types of educational videos and how you believe that we can improve it further. I'm definitely open to making more educational content for you guys, so let me know, leave a comment below, and I appreciate your attention.